Welcome to this presentation of order flows ratios and how to apply them in trading. My name is Michael Baltos. I'm the founder of Orderflows.com. First, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Okay, so the question I get asked quite often are, what are the ratios? And how do you apply them in trading? When you first hear the word ratios, I think people get scared. They think of, complex mathematical equations that, just go over their head. I'll be the first to admit, math was not one of my strongest points in school. And, definitely it was not a subject that I enjoyed. However, the markets do follow math, in the sense that, you could take ratios of what's happening in the market. When one side is stronger than the other, that's going to be important. And how can you tell which side is stronger than the other? Whether buyers are stronger than sellers is by using ratios to determine, their strength. Now, the Orderflows Trader software, it calculates ratios by looking at the volumes traded on the offer side at the top of a down bar and at the bid side of an up bar. Those are the extremes of the bars. People, when you want to look at, a volume footprint at a bar, there's a lot of numbers inside the bar. What you want to see what's happening at the edges of a bar. And if it's an up bar, you want to see what's happening, towards the bottom of that bar. Why is price acting that way down there that's causing the market to move in a certain direction? So if it's a down bar, the ratio will print above the bar. In an up bar, the ratio prints below the bar. So for example, I'll show you. Order flow ratios appear above or below the bar, depending on if it's an up bar or a down bar. Again, it'll appear below an up bar, above a down bar. So you can see the green candles are up bars. Obviously, we open here, we close here. The ratio prints at the bottom. Okay, on a red candle, on a down candle, a candle that closes lower than where it opened, it'll appear on the top, as you see here. Now you'll notice there's different colors. There's black numbers and there's blue numbers. I'll get into that in a second. Now, the ratio shouldn't be confused with the individual numbers inside of the volume footprint chart, inside of the bar. It's the number outside of the bar, either at the bottom or the top. So there's three types of ratios. There's a neutral ratio, which means the market is facilitating trade. And it's going to be a number generally between 29 and 0.71. Now, the next type is called a ratio bounds high, which indicates price is being rejected, and it's going to be a number above 30. A ratio bounds low indicates a price level is being defended in the market, and it's going to be a number between 0.7 and 0. So you see here, right, this is a ratio bounds low. It's a number. 0.59 is a number between 0.7 and 0. This one right here, 33.4, is a ratio bounds high. It's a number above 30. In 59, again, it's above 30, so it's going to be blue. 1 is a number that's in between. It's a neutral number as far as the order flows goes. 0.8, again, that's a neutral number. 1.18 is a neutral number. Okay, now in the settings, where do you find it? You're going to find it when you open up go to the indicators, and you click on Orderflows Trader. You'll see it in here. It's going to come under the footprint ladder. You have a ratio bounds high or ratio bounds low. You can change the color. If you don't like blue, you can change it to whatever color you like. And the font, I prefer to keep it a little bit bigger than the normal numbers in the footprint chart, and I like to bold it. and put in italics and underline, just so it stands out a little bit. Again, you want to keep it separate from the other numbers that you're seeing inside the bar. And again, you can adjust the ratio bounds high number, or you could adjust the ratio bounds low number. I use 28. Earlier just now I said, a number above 30. So you're looking, for a number above 28. The reason I have it set at 28 is, say it's 29.87. That's very close to 30. I'll look at the individual bar at the numbers involved and make a determination if I want to accept it or not. Again, the ratio bounds low, 0.699. So if it's a number like this one, 0.59, that's a ratio bounds low. That's a number that's below this. So what you're looking for is a number above the ratio bounds high and a number below the ratio bounds low. Okay, so why is it important? Why are ratios important? Well, they're generally going to be a sign of price rejection or price defense. And often they'll work best as a sign for reversals. So after a market makes a move, at some point the move is going to stop and the market is going to reverse and head in the opposite direction. You can also use them as a continuation sign when you're already in a trade. And that's just for confirmation. Whenever you're in a position, it's always nice to get confirmation in the order flow, to keep you in the position, so you know that you made the right trade. Okay, so price defense. Ratio bounds low is going to be a number below 0.699. And okay, if you're looking for a price that's going to be defended either at a low or at a high, you want to see a ratio bounds low. And it's telling you a couple things. It's telling you that there's stopping volume in the market, that at a low, that the market is being supported. At a high, that the market again has sellers up there. So you see here a ratio of 0.5961. It's right on the low. That's what you want to see. You notice you have these other lows here. These are just average numbers. They're not blue. They're just your black numbers. So it's telling you the ratios are just average numbers. And what happens? We come down here. It's telling you it's a ratio bounds low. Remember, ratio bounds low. It's a number below 0.69. And what it does, it's telling you that price is deemed being defended. That there's decent volume down here at the low. That buyers are willing to defend this low. And what happens? The market shoots right up. Again, what I was talking about, I alluded to a little bit earlier. Ratios also act as confirmation. Say you take this as your low, and you have every right to, because you have this ratio bounds low here. You're in the move, and you're getting confirmation in the move with a ratio here. A blue number as the market is going higher. Okay, so the next type is price rejection. And price rejection is going to be the ratio bounds high, which is a number above 28. Again, those numbers are not set in sand. It's not lying in the sand that you have to hold that level. So if it's not exactly above 30, I said, I use 30 in my head, but 28 is what I have it set at, because there's going to be times where it varies borderline. It might be 29.6, it might be 28.9. Now, I'll look at the individual numbers that are making it up and go from there. I don't have to, it's not, a red light, green light that if it's this number, I have to take it, and if it's off by even 1/10, then I'm not going to take it. No. Instead, it's a guideline that I'm using. If you want to stick with it where it has to be over above a certain level, then fine, you can. So, okay, we're coming up here. We get this this double top. The first time you hit it, you got a ratio of 41. Let's say it's triple top. Second time you hit it, you got a number 5.124, and the third time you got a number 49.4. Okay, so you have these two ratios here, right? 41, 49. In the middle, you don't have. You have a ratio, but it's not a number that you like. It's just 5.12. So it's not a blue number, it's a black number. And what these numbers here are telling you in these two cases, it's telling you there wasn't much interest in buyers to take the price higher. They're rejecting these prices above this level here at 162.19. The first time we got up, rejected these prices. Came back, we tried to make another run. You just sort of got an average amount of trade. But the third time, again, you get a ratio, and it's a pretty clear sign that prices above this level are being rejected. They can't take the prices any higher. And what happens? The market just comes right off. You can see I took this trade here. I got short at 14, covered it down here at 10. I could have got a little bit more out of it, but this was a trade that just lasted like 3 minutes. And what you're looking for, you're going to be looking for areas in the market where price is being rejected or price is being defended. Again, it's a number that's going to be above 28 in a ratio bounds high, or if it's a ratio bounds low, it's going to be a number below 0.699. When people talk about ratios, again, it gets a bit intimidating because you think you got to do a lot of calculations, but you don't. The software does it for you, and it puts the number up there for you to interpret and use it how you wish. So it can be used as a continuation sign. So we come up here to the swing high, and immediately after your high, you get a ratio, a ratio bounds high, indicating price rejection, since it's a ratio of 84. It's sort of followed up by another ratio bounds high a little bit later, again telling you prices again are being rejected up in here. So you imagine we come up to this high, start to sell off, make a run back up towards this high, but prices up here are being rejected. You can only see there's only interest of 14 lots here. Sell off a little bit, come back up, start to come off again, make another run up, but just even at this high, we can't even reach that level. And you get the sign that price is being rejected now here. Whereas before his prices up here above 62 are being rejected. Now you're getting a sign that prices above 60 are being rejected, and the market just works its way down. You have a ratio bounds low here on this move down, which again is telling you that, hey, now the market has turned sellers, and there's some people that have supply to sell that have, are willing to offer it out here to sort of cap any move higher. So you get, 1, 2, 3 signs of, price rejection, and now all of a sudden you have this area here where people are defending this price. They don't want it to go any higher. Now, a question that I get asked once in a while is there any importance in the strength of the number? Again, I'm looking for a ratio bounds high, I'm looking for a number above 28. Is, 300, 300 is a big number. 137 is a big number, whereas 49 is close to number 28. Is 300 more important than 49? No, it's a ratio. And why that's important is because it's taking into account the volume that's being traded up here or down, at the bottom of a bar. And so it doesn't really matter whether it's 300 or whether it's 49. What matters is it's above 28. So whether you see 300 or you see 49, I treat it the same. It's a function, these ratios are a function of the volume that's traded. So if there's lesser volume, sometimes you'll still get a ratio, but, it'll just happen on lesser volume. If you're just analyzing the volume by yourself, it's going to be a little bit trickier. And, it's just easier to trade with the ratio and have the calculation done for you and appear on your chart. So, the point I want to make is it can be used in pretty much all futures markets. I'll give you some examples of many different markets, and you're looking for the same things. You're looking for, the ratios, either ratio bounds highs or ratio bounds low. Like, okay, this is corn, right? It's a 4-range chart in the corn. This green line is the high. We hit the high twice, start to come off, you see a ratio just off the high, which is your first indication that price is being rejected. We made another run back up here. Yeah, we got through it by 2 ticks. And then we sold off. We sold off to another. This time it's a ratio bounds high underneath the bar. It's a, it's a green candle. It's an up candle. So you have the ratio below it. Oftentimes the market will trade from ratio to ratio. Not all the time, but it happens, quite frequently. One thing about the ratios is they won't appear on a bar that's a doji candlestick, meaning the market opened and closed at the same price. That's why there's no ratio below or above the bar. As far as reading in the ratios on a doji candle, where the opening and closing are the same price, it's neutral in that sense. I mean, I don't want to say you just disregard whatever happened in that bar, but as far as reading the ratio, it's neutral. Okay, so what is this? This is wheat. Again, it's a 4-range chart, and we're coming down into the low. We hit the low here. We got a ratio 61. It's a blue number. That's what you want to see. He even came back, tested it again. And the second time, he didn't have a ratio, but still the ratio held, and the market rallied. Then it sort of hit the swing high, and then after the swing high, you've got a ratio that you like, and the market started to sell off again down towards the low. This is the E-mini, and you're coming down into the low. You hit the low here, take out the low. All of a sudden, you get a ratio bounce low, indicating some price defense down here at the bottom of this bar, at the low of the day. And immediately after it, you're getting a ratio bounce high, another ratio bounce high. So, this area down here, now that we're starting to move away, sellers are rejecting this area. They're not interested. It's rejecting it in the sense that they don't want to sell anymore, and the market starts to rally. So now you're getting the ratios acting as confirmation after your initial ratio here, and you get 1, 2, 3, 4. You can just see, market is moving up right off the bottom. I mean, you're not going to be able to pick the exact bottom of the day, the low of the day, or the high of the day, but it can clue you in relatively near either the high or the low, either swing highs or swing lows, or highs of days or lows of days. I mean, to be honest, very few people are ever going to pick the exact high or the exact low. The best that you can hope for is to get in somewhere around the low or get in somewhere around the high. And that's what these ratios are going to help you do. Okay, is 10-year note, ZN. And again, we're coming down into the low. Boom, you got a ratio bounds high here, ratio 1.59, and it's immediately followed up by a ratio bounds low. So we come into this low, prices down here are being rejected. We start rallying up. You see price being defended here at this price of 130, is that 20.5? You've seen some big volume in here supporting the market. Again, we start to sell off a little bit. Again, you get another confirmation signal with the ratio. And, sellers are rejecting these prices down here. There's no more interest in people selling down here, and the market starts to move up. Okay, so, before you start thinking this is the greatest thing since sliced bread, there's going to be times where it's wrong. I mean, that's just life. Trading, not every trade is going to be 100% correct. There's always an uncertainty factor in the market. You don't know when, the big institutional trader, the big portfolio manager is going to start executing his market. You could have the best signal, the best setup in the world, but if literally at that, 10 seconds after you get into the trade, portfolio manager comes in with a trade that he's got to do, he's got some size to move that's going opposite you, you're going to get hit in the head. You're going to have to take a loss. You're going to have to get out of the market. I mean, that's just how it works. You don't know what's going to happen after you get into the trade. Yes, the market should go in your favor, but like I said, you don't know when that big order is going to come into the market, when they're going to start executing their order. I mean, in general, the market should, move the way it's supposed to, but there's always that level of uncertainty. Okay, so here's an example. Okay, so this is a ratio of 28.82. Like I said, I like to use 30, but I have my settings set at 28 because I do want to see numbers like this. 28.82 is very close. I could have had it set at 30 and this wouldn't be blue. But, again, I'm a trader. I like to analyze the numbers that are there in the market and make my trades rather than just take, red light, green light. And, looking at these numbers, they look pretty decent. You got some solid volume. I mean, if it was numbers where there just wasn't much volume, then okay. So, you're thinking, hey, it's all systems go. And you get long, and then the market just starts selling off again. That happens. It's unfortunate, but that happens. But your clue is you're starting to see a ratio here, immediately after you're getting long, that there's a ratio in the opposite direction. So that's a clear sign to you to get out. I mean, honestly, if you're not out, below this bar, below this low, that's where you should be looking to get out. Is if this ratio is going to be invalidated, we're going to come down. Say it's a bullish ratio, a number below the bar. If we come down and take out that low, then the ratio is invalidated and you should be getting out anyway. But even if this 16.24, say this was 36.24, that would be enough reason to get out. So it's going to give you a chance to get in, and you're going to know where your stops are going to be. It's going to be right below the low, or if it's if you're getting short, it's going to be right above that high. Now, again, I just want to show you another example where sometimes they don't always work out as much as you'd like. And again, this is a 5-range chart. I think this is just this is this one. This is a 10 range. When you break it up on a 5 range. Again, you got the ratio here, but then the market just went sideways. Okay. I mean, sometimes oftentimes they'll just work right out. I expect my trades to just work out. Once they start going sideways on me, that's a sign. So if I'm getting long based off of this ratio here, and I start running into ratios going in the opposite direction, that's enough a sign for me to get out. Sometimes the market just goes sideways on you. I mean, we all like the trade to go directly in our favor, but sometimes it just doesn't. But you could, if you're seeing ratios in the opposite direction after you get in, be careful. You should be looking to possibly get out, or cut your position a little bit. But I wanted to show you some examples. It's not a 100% perfect holy grail trading indicator. Definitely not. But it's something that will definitely put the odds on your side. I want to manage your expectations. So again, what should you look for? You should be looking for a blue number above a red candle, which indicates down, or a blue number below a green candle, which indicates up. You want to be looking for a number above 28 or a number below 0.6999. Yeah, I could say 0.7, but 0.6999 is good enough. So when ratios are black color, the market is doing what it's supposed to do. It's facilitating trade. So you see here, these highs, you're getting black numbers, black ratios. The market is, these are just average trading. It's average bars, average volume, and that's fine. I mean, it's not every high or every low is going to have, have a ratio, either have some price defense or price rejection. But there's going to be times when it does show up. I said most of the time the market facilitates trade, and you get average volume, average numbers in the order flow. Again, there'll be periods where there's no meaningful ratios. That's because the market's facilitating trade. Here we are, we're just going back and forth. You see no blue numbers. It's black, 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 black. The market is just going sideways for the most part, and it's range trading, basically between 48 and 42. It's gone down. This is what the market does. It goes up, it goes down, facilitates trades. What you're looking for are those areas where price is going to be rejected, price is going to be defended, and a move is going to happen. He said, don't come in thinking it's a holy grail that every low is going to have a ratio that you like, or every high is going to have a ratio that you like. It's not like that. But when it happens, that's when you want to take action. Again, be careful when trading a sideways market. If you got some ratios here, negative, 44, 36, it's ratios above red candles, which is telling you, I'd much rather be short than long when I get more ratios above than below. But for the most part, this market is going sideways. I mean, yes, you can make the argument that you should possibly be short. You got a ratio here, a ratio here. You could be looking somewhere to get short in here. But when you see this number in here, okay, if you're short, you should be looking to get long. But this market's going sideways, and oftentimes on sideways moving markets, it's you tend to get ratios sort of opposing each other. I like to see the ratios, after a nice move down, after a nice move up, not necessarily in the middle of an area. So, you got to take things in context. So, here's a nice move up, from this low here at, what is that, 2055.5. Boom, we trade all the way up to 2063.25. And you'll notice, you went from a ratio right up here to another ratio. You got a couple ratios, bullish ratios here. But where's your selling ratio? Is this blue? No. Is this blue? No. Is this blue? No. Is this blue? No. Finally get this red candle with the ratio up here telling you that there's, there is some volume up here stopping this move. Now, these numbers aren't necessarily as great as these numbers, but, it's a ratio. So it's taken into account the volume up there. Just as it took into account the volume up here, but it wasn't good enough as far as the ratio to give you a blue number. And what happened? The market came off a little bit, then went back up. Took out the high by a tick, and then you got the blue number, a ratio, telling you you should think about getting short. And what happened? This is that bar right here, and then the market just sold off quite nicely. Went down from, was that 62 down to, the 56 level. I mean, it did stop here at, what is that, 59. But, I mean, it's up to you if you want to take your profits, getting short up here, or if you, want to let it play out a little bit and come down. I mean, that's part of trading. And, after you get this ratio, you get it followed up by another ratio, again, telling you there's some confirmation of this number up here. We have price rejection ratio bounds high, it's 84. So it's telling you price up here is being rejected. And it's, again, it sells off quite nicely. Okay, so let me ask you a question. What are ratios telling you in this chart? Okay, well, just real quick, looking at it, you got a ratio bounds high, a ratio bounds low. Basically, the important thing is you have a ratio above a red candle, above a red candle, above a red candle. So it's telling you if you're not already short, you should have positioned yourself to be short. And we came in, we hit this low. Here, this red line is the low of the day. It's just an average number, 1.267. It's a black number. It's not blue. We start to move up a little bit, but then we sell off. Again, we get a ratio here telling you, this is a negative ratio. It's a bearish ratio, so to speak. And we come in, we hit the low, take out the low, make a new low. And we come down here, we have a ratio bounds low of 0.5961. So it's a ratio below 0.69. And it's telling you that there's some stopping volume in here. People are defending the market down here at this low. You didn't have it here. You didn't have it here or here. These are red candles. It's going to show up below the bar of a green candle. And this is a red candle, so the number's above it. So it's telling you, hey, the market's got some capacity probably to possibly go lower. And then what happens? It stops right here. The bar turns up. We come down, we hit the low at 20.48. Bar closes at 49.25. You got a ratio right here of 0.5961. So it's telling you that there's some volume, stopping volume down here. The price is being defended. And, here it is. This is what happens. The market just went right up from, 48.5, 49, all the way up to 55. And you're getting a couple of ratios along the way, which is confirming your move. It's confirming that there was price defense down here. Price was being defended, and the market moved up. Okay, so you can ask again, What are the ratios telling you? Okay, so the market's going up. You're seeing ratios, ratio. On an up move, you want to see bullish ratios. You want to see the ratios below the bars, indicating the green candles with some price rejection or price defense along the way up. And you hit the high. You hit it once, you hit it twice, you get a ratio up here. What are you going to do? Well, I'll just talk about this real quick. This is a 3 in a row setup. This is a ratio setup that I normally like to take. And again, I like to take them in context. I don't necessarily like to trade these, as you're making new highs. But this is a setup that I like. You get 1, 2, 3 ratios in a row, a red candle, followed by the green. So you're getting along somewhere in here. But what happens is you hit this ratio right here, okay? And this is what you gotta really be keying in on. I mean, yeah, it's nice to see all of this, but you're watching the market as it develops. I mean, that's what order flows allows you to do. It allows you to see what's happening in the market and trade off of what's happening in the market as it happens, rather than waiting, for lines to cross over or whatever garbage you want to look at. And what happens? This is your price rejection up here. Your ratio bounds high. It's the number above 30. And the market comes off, puts a little rally back up here, hits this ratio bounds low, telling you that there's some volume up here. There's people got some stuff to sell. People are defending this price. Price is up here, and the market continues to sell off. This was, I'd consider this a failure of a 3 in a row setup. However, even though it failed, you did have a sign that you should, that this trade is going to not work out, when you see this ratio here. If you have a setup and then you see, opposing order flow coming in, get out. Don't wait for the market to stop you out. It's going to, more often than not work out. And as you can see, it didn't. It went sideways a little bit before falling over. But if you're just going to wait for it to stop you out, there's no reason to. You have your reason to get out right here. So you can either get out with a small loss or, or break even. Okay, so summary. Blue numbers above a red candle, blue numbers below a green candle. That's what you want to look for. Take everything into context. Context. It's best to take any trading idea in context of the market. The reason why I keep saying context is, if you're looking for a reversal in the market has to have made a move. If the market hasn't made a move, it's just going sideways, you shouldn't be looking for a reversal. Again, look for when there's a move in the market. That's when you want to take signals. You could have the best trading indicator in the world, and you put it in the market that's going nowhere, going sideways, it's not going to perform as well as it should. So context. Again, if you're looking for a reversal, the market should have made a move. If you're looking for confirmation, the market should have reversed and start going in a direction. Don't look for a reversal in the middle of a market going nowhere. Don't look for confirmation in a market that's going sideways. If you can't tell where the market's going sideways, just look at a chart. If we're trading in a tight range over a period of time, the market's going sideways. Now, there are advanced uses of ratios. You can trade around your own levels. So there's pivots, Bollinger Bands, fib levels, etc. And just if you have your way of choosing support and resistance, look at the ratios when price gets there. What's the market doing? Are those prices being defended? Are prices being rejected? It will help you take better trades. There are setups that I'm always looking for in ratios. The 3 in a row, which is one that I showed you earlier. There's one I call the O2X, and there's another one called the second test. And another advanced use of ratios, so to speak, is trading them with stacked imbalances. I'll talk about that real quick. And what you're going to be looking for are when you have a stacked imbalance, right? You have this zone drawn out five price levels. You can adjust it with the software. But when you come back into the zone, if you get ratios, either in the bar after or the second bar, it's telling you that these prices are on the other side of the zone are being rejected. So you have the selling imbalance here. We sort of come back up. You got a ratio. It's telling you that, hey, prices above here are being rejected. You had aggressive sellers come in. You've got the selling imbalance. Markets move when the market's out of balance. So when you get a stacked selling imbalance, expect the market to move generally. And when you get in ratios immediately following it, it's telling you that prices on the other side of that imbalance, the stacked imbalance, is being rejected. And what happens? Comes right back up into this zone where the stacked imbalance is, and then sells off quite nicely. This is another example. We're going up into the highs. You're taking out the highs with some, aggressive buying. You got buying imbalance, buying imbalance, buying imbalance, resulting in a stacked buying imbalance. The bar immediately following it, again, you got a ratio, so it's telling you these prices, these lower prices below the high of the day are being rejected. And what happens? The market just continues moving on up. So, I hope this helps explain ratios and how to use them in your trading. Again, there's other ways to use them. I covered most of them. Like I said, the advanced uses. Once you understand the ratios, then you could get into the advanced setups. The 3 in a row, pretty much happens every day. O2X, not so much. Second test, a little bit less. Trading with the stacked imbalances, you get plenty of chances. During the trading day, they don't. The setups don't always appear every single day, but you should know what to look for when they are occurring and trade them. So to learn more about the software that I used in this video, visit orderflows.com. It's www.orderflows.com, or send me an email. You can contact me via the website. So I hope this makes it clear for more people, and good luck trading. Thank you.